Reader says, I am in my early 40s and do active investing on my own. Recently I was contacted by an agent who shared about investing in high-yield Asian bonds. I was initially skeptical, but it seems that these are very different from mini bonds, and the failure rate has been historically low. I am thinking of investing about 10% of what I usually invest in the stock market in these bonds. The main catch is that the investment commitment is over 10 years and I cannot sell for the first 10 years. This seems fine to me, and after that, I am able to decide whether to continue investing or not. Would you be so kind to share your thoughts, please? Many thanks. AK says, high-yield bonds are junk bonds. They are junk bonds for a reason, and you should be wary of the financial strength of the issuers or the lack of it. It depends on how much risk you are comfortable with taking and if you think the potential returns justify the risk. I wouldn't buy these myself, and also because there is a strange thing here about not being able to get out of this for 10 years. Whether regular bonds or bond funds, we are allowed to get out whenever we want, accepting whatever price Mr. Market should offer at that point in time. 10 years is a very long time, and with no escape clause, it is either we swim or sink with the issuer. Another thing is that with interest rates rising, if the issuer does not default, these bonds could be worth much less 10 years later, assuming that interest rates become even more elevated then. So, in such a scenario, if you do decide to sell the bonds, you might get back less than your initial investment. Of course, the decision is yours. I hear people saying that they put some of their money in bonds for diversification. They don't want all their money in equities. This is actually quite prudent. However, for many, the prudence ends there because they think that as long as they have a good percentage of their portfolio in bonds, they have done a good job of diversification. When we talk about diversification, it is to reduce the volatility of a portfolio. In the long run, all assets in our portfolio should ideally produce positive returns but do not move up and down together. The idea about having bonds in our portfolio is that prices of bonds and equities move in opposite directions. However, this is only true if we are talking about certain types of bonds. A sovereign bond that is issued by AAA-rated country like Singapore, or a high-quality investment-grade corporate bond adds stability to an investment portfolio. When we park our money in bonds which are of questionable quality, we are not reducing risk nor volatility in our portfolio. Do you wonder why is this so? Lately, we have been talking about interest rate risk. We have been talking about how rising interest rates would put a downward pressure on bond prices. This is especially the case for long-term bonds and perpetual bonds. So, if we value peace of mind, avoid long-term bonds and perpetual bonds. Also, avoid bond funds as they have no maturity dates and are like perpetual bonds. Now, it stands to reason that when the economy does badly and the stock market plunges, investors seek safe harbors for their money. High-quality, investment-grade bonds are one of the things they would go for. In a bear market, stocks of weaker companies or businesses of the more speculative kind get sold down more aggressively and, together with them, the bonds which they issued. Mr. Market is not worried about interest rate risk in such an instance. Mr. Market is worried about the risk of default. Where is the supposed stability that comes from diversifying into bonds then? Bought the wrong bonds. So, no stability la. So, if you have bought some bonds and because of that, you think you have added stability to your portfolio, think again. What are the bonds you have in your portfolio?